Hmm. All right. Good morning or good afternoon, depending upon where you are observing from. Welcome to the December 2025 monthly market update. Give me a second here to get ready. So I'll give another minute or so for anybody that is planning to join us before we get started. And then I'll jump into the numbers and the presentation. So I do have a little bit more to go through today. Hopefully that will be additive to the overall presentation. It's going to be a similar format as the last couple of months, with some additional information that we will cover. So giving it just a few more seconds before we jump in here. So okay. We'll probably have a few more people that are going to jump in as we go. But again, welcome to the December 2025 market update. This will be recorded and posted to our website and YouTube channel for later viewing, should you choose to do so. All right. So the first thing we're going to do is just kind of do a quick review of the Commonwealth quick hits. Monthly market quick hit. This should have been provided to you in the email invitation to this webinar. So go over that real quick, and then we'll jump into some of the other details. So U.S. equities during the month of November rallied across the board during the holiday shortened week. So the small cap Russell 2000 led the market, growing more than 5%. Treasuries also rallied. Investors responded to more favorable commentary about the possibility of an interest rate reduction next week. And the Federal Reserve speakers continue to cite concerns about the health of the labor market. So, a couple of points were, there's a question about how important the holiday shopping season is that we're now in towards both the economy and the markets. Uh, September retail sales and the November consumer confidence reports missed expectations. So there's a little bit of a dip in the markets in early November with a rebound. Equity markets led by the Russell 2000, which for those that if you're not aware, is an indicator of small and mid cap companies, and the NASDAQ composite, which is tech heavy. Those both rallied. And the ADP employment report for November and the University of Michigan's Consumer Sentiment Survey for December are expected this week, in addition to the Federal Reserve rate decision expected today. So that's the news. Pretty much all eyes are on the Federal Reserve right now. So we'll talk about that here in a second. But before we do that, let's jump into looking at the market performance and how things have fared over the last month of November. So this chart shows the various indices that we keep a track on. So first and foremost, we've got the Dow Jones Industrial Average that increased slightly over the month to up about 0.32%. That's the same with the S&P 500, which increased just by a bare 0.13%. So mostly even for the month. The NASDAQ was actually down a little bit. So there was a little bit of a concern about, are we in an AI bubble that led a lot of tech companies down? So it was slightly down for the month. International, that's the MSCI ex-USA index. So basically came in even. And the Bloomberg Aggregate Bond Index ended up slightly positive on the continued expectation of falling interest rates. So just mind you that the bond indexes generally rise when there's an expectation for rate cuts or declines in interest rates. Okay, so that is for the month of November. If we just zoom out a little bit and we look at the year to date so far, again, even taking into consideration the dip we had in November, it's been a pretty phenomenal year so far, with the Dow Jones up 12%, 12.16%, the S&P up 16.45%. The Nasdaq up a whopping 21%, and the leader of the pack, at least for this year so far, has been the international markets at 29.21%. These are all numbers through the end of November, so there's a little bit of a difference between the end of November and now, but effectively mostly flat across the board. So, and then lastly in here, the bond index is up 7.46% for the year so far. So, by and large, across the board, as far as investment is concerned, pretty solid numbers from the market performance. So now I'm going to switch gears a little bit, and we're going to look at another slide deck. Excuse me. All right. So shifting gears, something that just kind of came across my radar in the last few days. If you have not already seen the notice, Commonwealth was acquired by LPL Financial as of August 1st. And so now that Commonwealth is affiliated with LPL, which is a Fortune 500 company, we have access to both Commonwealth and LPL's financial analysis and reporting. So they put out a nice deck that I thought would be interesting in sharing some of the data that is driving both the economy and the markets going forward. So first and foremost, let's talk about the economy. So the more things change, they got this quote, the more things change, the more they stay the same. So let's just go ahead and look at what expectations are for the economy going forward into 2026. So there's a general expectation about a modest rebound in GDP, that's gross domestic product, in the later half of 2026. So what this chart shows is we had a slight decline in the first quarter of 2025, followed by a significant rebound. A lot of this decline is potentially related to the tariff announcements by President Trump, but then we saw a significant rebound as some of that got walked back and adjusted. So, but overall, gross domestic product has been sliding a little bit, partially on the concerns over unemployment or a declining or a softening job market. But going into 2026, there's an expectation about a leveling out of that and a rebound related to employment. So that's kind of an expectation about the economy. Intellectual property will be increasingly important to growth, and this is primarily tied to the growth related to artificial intelligence and the intellectual property aspect of what is coming with that. So, for the most part, inflation has been tamed outside of services. So, what this chart shows, the yellow line or the brown line, depending upon what color scheme your computer is showing, shows the overall CPI, Consumer Price Index. So as you can see, we saw a pretty big spike in consumer prices. They came down over the course of 2023 and 2024 and have kind of flattened out, slightly declining in 2025, with a slight uptick towards the end here. So there's some there's some analysis suggesting that maybe this is the slight uptick that we're seeing now is related to some of the tariffs, and that could be the fact, could be related. But as you can see, it's overall still been declining from the spike that we saw in 2022 and 2023. So, and I would expect, barring some other significant market or economic shock, that will probably be sort of flattened out in that range going forward. So something to keep an eye on. Obviously, people are still concerned about prices. I don't blame them. Grocery prices seem to be atrocious right now. And President Trump was on the road yesterday talking about that. So it's still something that's front of center and top of mind for a lot of people these days. But it's not as bad as it was a few years ago. I think we're still kind of feeling the effects of it, kind of a hangover effect of the spike that we saw. Now, services, the price of services, primarily driven by wages, is has been spiking a bit, and so that might be also attributable to why people are feeling the pinch. So, okay, let's talk about interest rates a little bit. As I mentioned today, the Federal Reserve is expected to cut rates once more by about 25 basis points. So that does affect longer term rates. And so the 10-year uh, treasury rate, that's the anchoring factor for mortgage prices. So typical mortgage prices are 15 or 30 years, so largely sensitive to the 10-year treasury rate. Right now, the short-term rate is sitting right about 4%. So with a rate cut today, as expected, there's a 90% expectation of a rate cut today, would take the Federal Reserve rate down to 3.75. So that's largely within the realm of expectations. Um, let me go back to the rates here. So there is also a continued expectation that rates will continue to be cut over the next year, so 2026, another two cuts sometime during 2026, which would bring the rate down to 3.25 to 3.5%. So I think it's a reasonable expectation to assume that short-term rates will probably settle in around 3% towards the end of 2026. Okay, there we go. Let's keep going here. So let's talk about stocks. And a lot of people are concerned about, are we in a bubble? History would suggest that we might be in a little bit of a bubble, but we've got a ways to go in this bull market. So, history, the last bull markets that we have seen, we're now in the fourth year of a bull market. Um, and that would point to potentially strong returns for this year or going into next year. So the S&P 500 surged by more than 80% over the first 3 years of this bull market, which is far outpacing historical averages. And if history is a guide, then the S&P 500 has averaged 12.8%, a 12.8% gain historically in the fourth year of a bull market. And so we potentially have some more room on this, but given the fact that there's some concerns about the labor market and are we in a bubble, there could be some volatility even if we are still in a secular bull market moving forward. So additionally, stocks do tend to rise after the federal rate cut occurs. So now we're kind of at an all-time high or close to it. So there's a little bit of a question or concern here, but if you look at that top line on this chart, so when you have cuts, when we're not in a recession, that leads to fairly substantial equity growth. So, that would suggest that we're not in a recession right now. So that would be the chart or the guide of where we potentially sit right now. Again, going back to talking about the AI boom and what are being called the hyperscalers. Those are the companies, largely the Magnificent Seven, that are investing in AI. So this is an estimate about the expected investment into AI by these hyperscalers. So you can see the exponential growth that is occurring in this area. It's got a 40% compound annual growth rate. And I think part of the reason we're not seeing a larger amount is just by sheer capacity, construction capacity for chips. You're limited by physical ability to construct stuff. So some of these companies would probably be even more aggressive if they could, if it weren't limited. They weren't being limited by just physical capacity constraints. So they are continuing to drive the earnings in the overall market. They have had substantially higher earnings than the broader S&P 500. And as far as we know right now, there's an expectation that that's going to continue. I'm not going to talk about politics right now. I'll say a little bit about bonds. Again, as rates fall, bond prices, bond values tend to rise. So if the 10-year Treasury yield and the short-term yield are continuing to fall, that would tend to indicate that we have a tailwind for bond prices continuing into next year. So, this suggests that if you are, I'm not going to talk about credit spreads. I'm just going to stop here. And so this suggests both, if you are both a stock investor as well as a bond investor, or have a diversified portfolio, assuming that you are able to kind of manage the associated volatility, that we would see continued portfolio appreciation on both fronts going into 2026 and 2027. Okay. It's a long way out, but right now things generally look still pretty good. Okay, so alternative investments is related to generally investments that are not publicly traded, things that are less liquid. This slide shows that mergers and acquisition activity is continuing to grow, and the deals are getting larger. So, that I think is also suggested that businesses that are strong with strong cash flows, strong product potential, are continuing to be acquired and continue to add to both market performance and the growth in the economy. So currency, let's talk about the dollar. As some people are aware, the dollar slid recently, right? But it was coming on almost close to an all-time high. But if you look at this chart, it says the dollar is down, it's not out, meaning it's been on a secular uptrend. It's had an uptrend over time. I think that if we're looking at some of the things that we just talked about, that could potentially continue for some time. If anything, flattening out. I don't see a cratering of the dollar. I don't see the dollar being, swapped out by any other currency as the international reserve currency, at least not in the short term. People have asked about whether cryptocurrency could take that place. Possibly, but probably a long time from now. Commodities are on a verge of a breakout, so we've seen an uptick in commodities. Everybody's probably aware of the gold price that we've seen with it breaking 4,000 an ounce. Almost, seems a little crazy. So there is still a demand for uh, gold and commodities as a hedge against inflation. So as we've seen, inflation has come down, but it's not out, and gold and silver and other commodities are a place that people tend to go to hedge against inflation. I also think that there is a degree of additional commodity demand for gold and some of the other rare earth elements that are being used more in actual production. So it's a limited commodity, and so if there's more demand, then it pushes price up. All right, so so that is kind of a quick summary of various aspects of that are impacting the market. I'm going to go back to my other slide here. All right, hopefully that was a good, quick summary for everybody. I'm going to open it up for any questions that anybody has. Oh, click the right slide. Let's open it up for any questions that anybody has. So you feel free to unmute yourself if you do have any questions about anything that I just reviewed. And I'll give it a few seconds. Okay. All right. If there are not any questions, then I will close off by just going over when the next sessions are scheduled. The next monthly market update is scheduled for Wednesday, January 7th at 11 a.m. So we'll do something similar next month. May not be quite as detailed, but I might go over some of this stuff again. So, but January 7th, Wednesday, January 7th at 11 a.m. Pacific. Also, continuing on into 2026, I'm going to continue doing webinars on various financial planning topics. So the first one for 2026, I'm going to be talking about investor psychology, how our brain impacts investing decisions, and the things, the cognitive biases and other types of things that impact investor decision making. So that will be held on Wednesday, January 21st at 12 p.m. So feel free to register for that. You can look for the invitations to come out for both of these in early January. Okay, they will also be posted on our website, so feel free to register either way. But look forward to doing those sessions going into 2026. So thank you for joining us today. Thank you for joining me today. If you do have any questions about what I've reviewed, feel free to give me a call at our phone number here or email at info@leslieripperday.com and join us for some future webinars. Okay, hopefully this information has been helpful and informative, and I wish everyone a happy holiday and a pleasant new year. Go take some time off for yourself and your family and enjoy. All right. Many thanks. Take care.